Okay, and thank you for coming to today's CALOP seminar. I'm happy to introduce Professor Michael Pinedo. Actually, he is the advisor of my postdoc at NYU quite a long time ago. So let me introduce Michael Pinedo a little bit. He is currently a Junior Strategic Professor of Operations Management at Stern School of Business at New York University. And his main research area is scheduling, but today his topic is for operational risk management. And he has let me tell you his background. He got his undergraduate major is mechanical engineering at Delft University of Technology, Netherlands, and then he moved to the United States. He has a master's degree and PhD degree in UC Berkeley, IEOR. And then he got a faculty position at Georgia Tech. And then he spent around 15 years at Columbia University in industrial engineering, IEOR. And he moved to Stern. So yeah. Today, I'm very interested in today's topic because I'm not an expert on this field. Yeah, please welcome Speaker Michael Pinedo.
It's a pleasure to be here and talk about this topic. It's different from the topic I spoke about yesterday, completely different. The reason was when I was at Columbia University, I was doing scaling because I was in industrial engineering and operations research. Then I moved to a business school at NYU. And in the business school, the dean wants you to do something what he calls relevant. So that must be for the finance industry. And he was not really that interested in scaling. So he asked me to do something else, which is risk management. Risk management in a business community is actually incredibly important. In the finance world, by the way, there are, maybe some of you know about finance, are three risks. The three basic risks. There are some other risks associated with it. One of them is credit risk. You know what credit risk is. A bank has to give a loan to someone. What is the probability the person goes bankrupt and the bank loses its money? That's credit risk. What is market risk? The bank has to invest assets in the market and has to buy stock, has to have positions, and the market can go, or even the real estate market can go in some direction and the bank can lose money. So credit risk, market risk, and then it turned out that only 20 years ago, they found out there is a third risk. And now that third risk of the banks, that is the major risk. That is the major risk that's called operational risk. Why do we know it's the major risk? How can we measure the riskiness or the level of risk of that risk? So I tell you, you have credit risk, market risk, and operational risk is the most important one. The reason is every bank has to put money in reserves because the government regulators tell the bank, hey, listen, you do business, and sometimes business may go bad, so you have to put money in reserve. And the government decides how much that will be. And the government has what we call regulators. Every country has its regulators. Korea also has its regulators. And the regulators visit the banks to check the books because they don't want the bank to go bankrupt. They don't like it. The regulators come and look at the books of the bank and they want to know if the bank has put enough money in reserves. And that's a very, very careful calculations. And that's not really, that is people with PhDs study the books. How much money should the government put in, this bank has to put in reserve? And then they usually say, we have to look at the credit risk reserve, the market risk reserve, and the operational risk reserve. So the three reserves are calculated separately, and the total reserve is what a bank has to carry. So that's for every country. It's very important. So country, you know, you don't want the banking system to collapse. That's not convenient. So you have to have good reserves. Now they found out 20 years ago that a major risk for the banks is not credit risk and market risk. The main risk is operational risk. And the operational risk, we are going to talk about what operational risk comprises and how do you prevent and mitigate operational risk events. By the way, that is from operations people, operational risk management in the financial services, in established banking systems, as well as in fintech. It's incredibly important. And it's much more difficult to compute the reserves, the necessary reserves for operational risk than for credit risk and market risk. For credit risk and market risk, it's easy to, people have experience how to compute the reserves, and people are not afraid anymore of those risks. Of operational risk, everybody is still very afraid. And that goes, let's put it that way, I can tell you which level it goes into the government. In the United States, the level it goes to is Donald J. Trump, which is very high level. So you can imagine it's an important topic. It's important. They don't want the bank to collapse. Let me tell you also something else. I studied this for maybe 20 years. And I have seen very interesting things happening in Japan. You would be, you know, in Japan, there are operational risk events, and some banks had to completely restructure or had to be bought over by other banks, big Japanese banks. Daiwa, Mitsui, they had to be taken over by other banks because the government say you cannot run your business because you don't do a good job. In Singapore, there have been interesting cases. In Hong Kong, there have been interesting cases. Even in China, we know about some interesting cases, even though China, of course, you can imagine how China is. If something happens, somehow they manage to keep it out of the newspapers. But still, we are able to find out. Now, there is something funny. About Korea, I don't know about any major event in the last 20 years. It would be nice to know which event, which bank came into trouble for what reason, and what happened, what caused the trouble. By the way, there are some interesting cases of, you know, maybe the European banks. I don't know, do the people here know anything about banking or no? If I mention a company, you know, there is something called Deutsche Bank. You know Deutsche Bank, it's the biggest bank in Germany. By the way, it's terribly managed. There is a bank, what used to be the biggest bank in France. It's called Société Générale. Because of an operational risk event, it became the third biggest bank in France, and the other two banks have passed it because they were so stupid. It's incredible. So in Europe, there are some very, very interesting cases. Okay. And maybe we will talk a little bit about Japan because, you know, there were some interesting trades in Japan, a human error in trading. And, you know, if you've looked at the Japanese typewriter, it's different from a Western typewriter. So a trader that has to work on both typewriters may have, usually you think the Japanese, in comparison with the Americans, make less mistakes because they are more quality oriented. Well, the funny thing is that they make more mistakes. And for us, the Westerners, it's very, very interesting. Why do the Japanese, which we think should make less mistakes, actually make more mistakes? And one of the things we were looking at, those people have a disadvantage that they work with different typewriters. Have you seen how a Japanese typewriter works? It's different. And if you have to put in, you have to enter a trade, and you have to enter a trade, it's different from the putting in a trade, and suppose you work for an American company in Tokyo, people can make mistakes. And people can make mistakes, and some human errors have caused I can tell you how much it has cost the banks. Human errors have cost in the billions of dollars. And the funny thing is, it's a human error you or I could have made. So we were thinking maybe it's a typewriter that is the difference. And it turns out that's not really so much the difference. There are other differences. Okay, we are going to look at, by the way, there was, well, I can tell you one operational risk event. That was a Korean airliner, I think. Because operational risk, besides banking and the aviation industry, it's right now they're looking at Air India. But what was it, a Korean airliner that was shot down by the 20 years ago? Yes. Yeah, that was, and then they had to change something in Korea. You know what the problem was. Huh? So a person makes a mistake, and this was the captain of the plane, made a mistake, and the second in command knows it. But in the Korean culture, the second in command is not allowed to tell the first in command, hey, listen, you're making a mistake. In the West, if it's two people from New York, they say, hey, listen, well, you're an idiot. In Korea, you cannot do that. And you remember what happened then. Huh? The plane went down. And and then they had to change things. Huh? So people had to tell the Korean crew, hey, listen, if you think that somebody is making a mistake, you have to open your mouth, even if the guy is a very, very important guy. So certain things like that happen. It's actually fairly interesting what will happen with Air India right now. They're starting an investigation, huh? Because how can a plane take off and the engines are being cut off from fuel? You have read what's happening with Air India, huh? That they found what the reason is that the plane came down. Now they're starting, I think they started yesterday. There is a big investigation going because affecting all Boeing planes. Okay, this is just to tell you a little bit about operational risk. Operational risk is, in Korea, I haven't heard, well, Korea is also a relatively small country, only 50 million people, but it's comparable to countries like France and Germany. We don't have many cases, but okay. Let me tell you a little bit. I'm going to give you the following thing. We first are going to give you an overview of the types of risks. Then I'm going to give you an example of an industry where it can occur, financial services and fintech. Then I'm going to talk about famous risk cases in the past and what people learned from those risk cases and how they have been dealt with. So basically, with risk, you want to know all the potential risk events. So basically, your company actually, and that even includes strategic risk, you want to know in advance what could possibly happen, with what probabilities, etc., and what are you going to do to prevent. And if it happens, you didn't prevent it, what are you going to do to mitigate? So you have to have all that in place for each type of event. So we're going to look at famous risk cases, and then we're going to talk a little bit about basic concept, techniques, and tools in risk management. By the way, if you do risk management, and if you are a good statistician, and you want a job in the banking world, and you say that you're interested in risk management, in the United States, you get a job immediately, even if there is a hiring freeze in the company. If there is a hiring freeze in the company, you are good in statistics. You have to know how to analyze data. And you really can show that you are well read on risk management, that you can go through an interviewing process. A bank with a very solid hiring freeze immediately will hire you. Because risk, they have to hire. By the way, they even have to show it to the regulators because the regulators visit them every year and they have to tell them how many people did we hire. So that's the situation in the United States. In Europe, it's the same thing. In Europe, it's the same thing. Even though the banks, they are all in cost cutting, the risk people, they will hire. Okay, so overview of the risk types. First of all, let's give, we can find in every book, actually with a PhD student of mine, we have written a book on risk management and financial service. It's a fairly cheap book. Nowadays, it's only, I think, only $50, but okay. You can choose. I'm pretty sure you will be able to somehow find a free electronic copy of the book. And it's on risk management in the finance world. So what is risk? It's uncertain events or conditions that if they occur, they have either a positive effect, so that means there are opportunities, or negative effects or threats on certain objectives that you have. So that's risk. So that can be positive risk, there can be negative risk, and you would like to know what they are. So what is risk management? Risk management is a process of identification. So you have to identify all possible risks. You have to evaluate, and you have to prioritize the risk. And then followed by coordinated economical application of your resources. And the resources are for prevention and mitigation. And so minimize, monitor, control, probability impact of unfortunate event, or maximize the realization of opportunities. So that's one definition of risk management. You'll find many other the moment you study it. Okay, so what is it? You start out with identifying risk, all the possible risks. There is interesting, nowadays, I had a consulting contract with something called the Hong Kong Jockey Club. Maybe you don't know what it is, but let me tell you what it is. You know what Hong Kong is. Huh? It's a city there very close to China. A Hong Kong Jockey Club is a jockey club that most people don't. It gives 25% of the government income of taxes comes from the Hong Kong Jockey Club. So that's horse racing, and people bet on the horses. Who wins? 25% of the government's income comes from the jockey club. So it's important for Hong Kong. On top of the 25% that they give to taxes to the government, they give that same amount of money donations to all the universities and all the hospitals in Hong Kong. So the moment you enter a Hong Kong university, you see the biggest building there, it's the jockey club, blah, 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 or some person. So it's apparently a moneymaker. What is the risk that those people, why? They are afraid of risk. So one of the risks you can, by the way, they have horses. By the way, the horses is actually Hong Kong Jockey Club, of course, the betting of their horse racing. Huh? Every jockey club, there is horse racing. That's part of the business, a small part. And you can imagine there is already some risk there because a horse is worth very often $10 million. And very often a horse has maybe 3 owners. And if there is an accident and the horse breaks his leg, by the way, there is insurance. Huh? Of course, you have to insure. Insurance is some way of managing risk. And not only that, you do it yourself with life insurance and health insurance. Okay, so the horse, $10 million, but if you have to go to the doctor, it's not a big deal. But the horse, that's a big deal, because the horse is worth a lot more money than you or I. If the horse has an accident, it's $10 million gone. So that's part of the risk. By the way, that's actually only a very small risk. But because you can imagine already, where does a jockey club make money? Not just people come pay entrance fee to watch the horses race. By the way, it's very fascinating. Go and look at it. It's like going to a soccer game. You have to pay an entrance fee. The entrance fee is not that small, so they make money there. Okay, they make money on betting. The Chinese mentality, I don't think that the Korean mentality is different from the mainland Chinese mentality. The mainland Chinese likes to bet, likes to gamble. And they cannot do it in mainland China. So they have to go to Hong Kong. So it's a big business for Hong Kong. Okay, so there is betting. By the way, nowadays, most people don't know, where is the main money of the Hong Kong Jockey Club? Is it on the betting of the horses? Because also there was actually one guy that came from an industrial engineering department in Hong Kong, a British guy that had a degree there, started a company on placing optimal bets in the Hong Kong races. And that guy became a billionaire. He had at a certain moment 50 people working on statistics of horse betting, and he became and there are people that do that know how to manage risk. And they can become billionaires. Actually, Hong Kong right now, something else. Their main money is not horse betting, the gambling, accommodating people to gamble. that the people in Macau also, they have casinos there, okay? No, the main money comes actually soccer betting all over the world. By the way, that is interesting because so the main betting on soccer all over the world is done in Hong Kong. By the way, the guy who, I probably will, this will last 2 hours. Well, you have to tell me when to stop. Okay, let me finish this story. I will not talk. So the reason what happened is, the president of the Hong Kong Jockey Club is a German guy who used to play soccer for one of the German clubs. He married a Chinese lady, very happy, in Hong Kong. So he lives in Hong Kong, married a Chinese, and is the president of the Hong Kong Jockey Club. And he says, on the horse racing, you cannot make that much money. Enough. They thought it was enough already because it really helped the economy of Hong Kong. No, you have to do soccer betting all over the world. So right now they have a department, 50 traders that bets on soccer outcomes in real time of games that are played all over the world. And the games, and mainly it is, I would say, they're concentrating mainly on European, the top league games, but also on South America. And right now, that's where the money comes in. So that's an opportunity, that's where the money comes in. And I really wonder who in Korea does it. Because apparently you like soccer also, so there must be some people. They have 50 traders that are sitting there in front of desks. So for the Hong Kong Jockey Club, that's their main money maker. 50 traders that are watching games and placing bets. And they have, of course, because they are in the business, they should be able to make more money than if you and I come there and we are going to place a little bet. We don't know the games that, and by the way, you can change your bets while the game goes on. There are rules for that. So you can imagine that's risk management. But they are afraid that at a certain moment, something very unexpected happens in a game or something. They had something very unexpected happening in one particular game. That the outcome was, in a game that you think that for sure this club is going to win, and you would say 100 to 1 that this club go, and the club that should have lost for sure, that club won. And actually, the Hong Kong Jockey Club on that game, in one simple game, they made $100 million. So they had their position right. But now you can imagine already, this is trading on soccer bets. Now you can imagine if you're going to work for, I don't know how many of you are going to work for a financial services company in Korea. What are the Korean banks? Where is the biggest risk? You know what foreign exchange is. The biggest risks that banks have, they have a foreign exchange trading division. And so the people do trades every day on selling, well, you know how, so you have large companies here, Samsung, so Samsung goes to the biggest bank, and Samsung says, hey, listen, I need, to the biggest bank, I need $500 million 6 months from now, and I want to buy it 6 months from now at that price for so many won. So I want to make an exchange, $1, 6 months from now at that price. And bank makes a computation and makes a guarantee. Okay, that's a foreign exchange rate. So we have a maturity date, we have an exchange rate, and we have to, because Samsung has to run its business, we have to decide what is the deal. So that's what we call a foreign exchange trading desk. So the big banks, I can tell you the big banks in the United States, and maybe you can tell me that a big bank like Goldman Sachs, that foreign exchange department of theirs does 100,000 trades a day. So I think a bank here in Seoul should do 10,000 trades a day. Pretty sure. You have your big companies that need foreign exchange, Samsung, Hyundai. So there must be many trades. Yeah? So you're talking about tens of thousands of trades a day. A trade, one trade, can be the size of $1 billion. That I say, hey, listen, I need 6 months from now $1 billion US, and I want to be able to have a guarantee that I can get that $1 billion for X1, for so many one. Okay, and the bank has to give that guarantee, and we settle it right now, and 6 months from now, the money changes hands. Okay, that's a foreign exchange rate, and we have 50,000 trades like that. Not many trades are small. A small trade, $10 million. Okay, many trades, but you have tens of thousands of trades a day. And now what happens now? So that's the department where the government is the most afraid of, that something serious can happen, that a bank can go under. So that from one day to the next, you think the bank that you thought was very safe and you have your money safe there, suddenly you hear a newspaper the next day that, hey, listen, we have to liquidate the bank, the government has to step in, et cetera, the whole top of the bank is being fired, et cetera. Okay, it has never happened in Korea yet, huh? But it could happen, you never know, it could happen. This is what we call risk. Okay, so at least you know a little bit about where we, in New York, when we think about risk, what we think. There is actually, I can tell you some very interesting things about risk. There is a lot of human error involved, because if you decide, one very common human error is, Samsung tells you, I need $1 million that I get from the bank, let's say about $1 million, no, Samsung probably need $500 million on that date, okay? And on that date, I give you so many won. So I know the $1 exchange for that day 6 months from now. And I give you the dollars. No, you give me the dollars, I give you the won. So Samsung gives the won, the bank gives Samsung the dollars. What is the most common human error, which happens all the time? That the human trader says, no, the bank gives the won and the company gives the dollars. Okay? By the way, you and I can make that mistake. It's a very interesting mistake. By the way, when we look at the frequency of that mistake, it's actually quite amazing. Quite amazing how that frequency of that mistake. Now, there is something very funny about human error. Whenever you make a mistake in a financial transaction, most of you have taken a finance course. And what did they teach you in the finance course? That markets are perfect. So if you make a mistake and you did the opposite move that you intended to do, when you think that you were going to buy a stock, instead of buying the stock, you sold the stock, so you made the opposite. Because the market is perfect, supposedly, a mistake has a 50% probability of making you money or losing money. Because after you correct for the mistake, you'll find out what the mistake is. Markets being perfect, if you did the reverse position that you intended to do, with perfect markets, you could make money on a mistake. Okay. Now it turns out, when I was an academic and I go work in this area 30 years ago, I thought markets are perfect. So if you make a mistake, 50-50 chance you're going to make money on the mistake. It turns out that if you make a mistake, by the way, I guarantee you here in Korea also, 70-75% of the time you lose money. And only 25% of the time you make money. That's the first thing. So the frequency of losing and making money, if you make a mistake, it's most likely you're going to lose money. Now, very often with risk, you have two probability distributions that are important. One is the likelihood that an event happens, so that something wrong happens. And then the distribution that if it actually happens, what is the damage? Even in an airplane crash, what is the likelihood that the airplane crash happens? And if it happens, what is how many people got killed? Okay, so you have what we call a frequency distribution. That's very important. And so when you have a frequency distribution in risk management and a severity distribution. So the frequency distribution tells you the probability that the event is going to happen. If it's a high probability, then it's an event that you really have to prepare for and try to prevent. And the severity, if such an event happens, what will the damage be? Now, let's go back to the human error. Human errors are always, because the Air India crash, that was a human error, for sure. Guaranteed that was a human error. And you can say the Korea crash, probably you can classify, that's actually very interesting. People may not call that a human, may call it a different error, but okay. But the Air India, that's for sure a human error. Okay, so now, if you make an error, I told you in trading, if you work for a bank, I told you already it's more likely that you're going to lose money because of the error, and there are several reasons for that, than that you're going to make money. Now let's look at the severity distribution. If you do make an error, but if you happen to make money because of the error, because 30% of the time you may make money because of an error you did. The gain, the distribution of the gain, has a very small mean. The expectation of the gain is actually reasonably low. Okay. Now, if you lose money, the severity, now we have an interesting distribution. It's called what we call in statistics, I wonder how much statistics you have, extreme value distribution. So now, if you lose money, the expected loss could be a lot larger than if you make money because of the error you made. And that distribution has what we call in English, I don't know what you call it here, a fat tail. Do you know what a fat tail is? Okay. So that's why in risk management, we are very, very interested in fat tail distributions. Okay, let's go quickly and tell you a little bit. It probably will be 1.5 hours, not 2 hours. In Wall Street, you start with this talk at 6 o'clock, and probably at 11 o'clock, people don't go home. Okay, you have to identify risk. You have to find out what are the possible risks. You have to assess the risk. Then you have to control it. Control it means preventing. So put in actions in place that lowers the risk and prevent and mitigate. And you have to continuously review the controls. That's the, okay, there are a couple of basic risk concepts that's important. One, it's called the risk appetite and risk tolerance. What is risk appetite? Suppose by chance you're going to work for a bank. Of your graduates, what percentage works for the financial services? Very small. And yeah, with us it's very, very large. Okay, there is something called the risk appetite. If you work for a bank, you should have some risk appetite, because if the bank doesn't take risk, it cannot make money. The risk is that you have to take risk, otherwise you're not going to make money. So they should take risk. Oh, by the way, even companies on a strategic level, when Samsung brings out a product, a new product, it's basically a risk. Will the product fly or doesn't it fly? You know, there was with Apple, for example. Apple put out a product, this was before most of you were born. It was called the Newton. Anybody here have heard of the Newton? That was long before the iPad. It was in the 1980s, 1990s. It was a personal digital assistant, PDA, they called it that. And so you could write your notes on the screen. You could write it on the screen. Of course, it had already then, this was in machine learning. So the Newton was learning to interpret your handwriting. And then whatever you wrote, it typed it up for you. So you have it very, very nicely. It was, you know, Apple was like that. They come up with, and this was in 1990. And this was a personal digital assistant. And there were people that bought it. They lost money, for sure they lost money. But, so it's a new product. You launch it, by the way, but it loses money. But by the way, they still, even afterwards, they probably would have put in, because they have learned a lot. They learned a lot in marketing the product and seeing, hey, listen, and already then in 1990, they were talking about machine learning, that we have to be able to recognize your handwriting when you write it on a screen, and we can immediately put it in, we immediately typeset it. There was a lot of learning, so it must have had some benefit for the future of Apple. It's not completely clear, but okay. So you have risk appetite, you have risk tolerance. How do we measure? So risk appetite is the amount of risk an individual or organization is willing to take. Well, you know what risk appetite is. If you want to decide that you're going to buy stocks, and you know a particular stock, how much money are you going to put in it? And you have a certain appetite, it determines what you're going to do. Risk tolerance is how much market risk, swings in political events, or interest rate change an investor can tolerate. A bank has to know what its tolerance is. By the way, they have to know what it's not, because the government is going to ask them, how do you compute that? And they look at statistics and they don't, it's really fairly. So we have to measure appetite and tolerance, and how are we going to embed risk management in organization, and that's called enterprise risk management. Okay, enterprise risk management is fairly important. This is enterprise risk management. We have to do. What is our risk appetite? Because we are going, for sure in the bank, we are going to take risks, because if we are not going to take risks, we are not going to make money. There are some people, I'm pretty sure here you have a lot of startup companies, and even here you have startup companies. The people that start up a company, they are taking a risk, probably 2 years or 3 years of work, and they have a certain probability that the company will fly, and a certain probability that 3 years from now, they have to look for another job. Okay, that happens a fair amount. So, you know, and by the way, I don't know what your probabilities here of startups by POSTECH. What is the probability that you get that the one is a big hit? 20%? 30%?
I don't think so.
What?
5%?
5%. So you know what CVs, venture capitalists, have to do. So they know all those companies. By the way, they analyze each one of them, and you have to put money, you have to diversify, and if you have 20 of those, but it takes a lot of time investigating, each one of them have 5%. But if you invest in 30 of them, 1 or 2 will hit the jackpot, and that pays for so the venture capitalists, they have a whole system in place. They have a whole system in place on how to aggregate all the risks so that they can, because they cannot just put all their money in one company. That's too risky. So how do we do that? Okay? So risk identification, risk assessment, and risk mitigation and controls, emergency preparedness and response. I can tell you one bank that is very good at that is JP Morgan Chase. Maybe you know the bank. It's the biggest American bank. They are so they had at a certain moment one guy in London doing funny things. By the way, very often a bank is in trouble because some guy somewhere far away is doing funny things. You know, there are at least 30, 40 stories of things like that happened. The way Jamie Dimon, their emergency preparedness, boy, they had immediately a team flying out to London, and they managed to control the damage. By the way, the damage, because the damage was $3-4 billion. But $3-4 billion for JP Morgan Chase, it's really not that much. But still, Jamie Dimon was not happy. So emergency preparedness and response, business continuity planning, etc., etc. And then process improvement and training, etc. So this is enterprise risk management. Okay, let's talk about the different types of risks, and all of them are, one of them is strategic risks, very often with mergers and acquisitions. Product development, you have a long-term risk. By the way, there were some very interesting cases in the last 10 years, especially with General Electric. I think that all of you know General Electric. It's a company of the size of Samsung. And I think that the guy, the CEO, must have been a complete idiot. he was a Dartmouth, he was not from He was really unbelievable. It was a merger, and the merger, you look at it as academics, and you look at the data that you can have, and it really did not make any sense. It was a French company that they wanted to merge with, and it really weakened General Electric considerably. The company was Alstom. It was okay. Now you know financial risks. We talked already a little bit about it. Well, you know about supply chain risk. Supply chain risk is interesting. And by the way, supply chain risk, for example, a company like POSTECH, if they have their analysis of supply chain, I can guarantee you they have some people that are analyzing supply chain risk. So what is supply chain risk? Each company, think about it, you know this thing, the iPhone, I have an iPhone 10 there. You know who makes it, huh? It's a Taiwanese company, huh? Foxconn. Okay, you know how many first-tier suppliers have to put in elements, first-tier suppliers in their supply chain? How many companies have to supply a product that goes into that little thing? And how many companies are first-tier suppliers? By the way, Samsung is one of the major first-tier suppliers because of the memory chips. So the iPhone, Samsung is one of the major suppliers. But how many are there? On the first tier, we are not even talking yet about the second tier and the third tier. You have an idea? What is the order of magnitude? You took a course in supply chain management? 700 first-tier suppliers. Okay, so on the second tier and the third tier, you're talking in the thousands. Okay, there are some major ones. Of course, Samsung is a major for the iPhone. Samsung is one of the major suppliers. But you're talking, it's said that Cook, the CEO, knows all the 700. Can you imagine that you know 700 companies? The guy must have a reasonably good memory, that no one. Okay, now you can imagine already what can happen. So you can have tsunamis in Japan. You can have earthquakes in Taiwan. At a certain moment, a supplier suddenly cannot supply because of some disaster. Okay, and by the way, that could happen, for example, with POSTECH, it's mainly raw materials that come from certain places, but so maybe there can be an earthquake or a mine can collapse. We have some very, the number of mining accidents that happen in the world, it's a little bit depressing. Do you have mining here in Korea? Yeah, are there accidents? Do they keep track of the number of accidents and all that? But there are very interesting mining accidents. But so the moment a tsunami or earthquake happens, a supplier falls out. And then immediately what happens then? So you know already, remember the tsunami in Japan, how many years ago was it? 8 years ago, 9 years ago? There was a tsunami in Japan. Which industry was the most affected?
Battery.
Yeah, the car industry, but especially the car industry. The car industry was very affected in the United States, so it must have been you must have depended also on the Hyundai. I really wonder what happened, the tsunami, how did that affect Hyundai? Well, okay, so you know now sort of, if you have supply chain risk, you write a contract with the company, but there is a risk that a company cannot deliver. Really because of, disasters or whatever, or maybe because of strikes. So you have to write, and by the way, contracting, so when you do supply chains, you have to study contracting. You have to study contracting, how do you have the secondary supplier, how much do you guarantee, blah, 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 blah. And the contracts are actually quite interesting structures. And the structure of the contracts in supply chain are basically to be able to handle the supply chain risk. Okay, supply chain risk. Project risks, that's product development. By the way, you can imagine pharmaceuticals, you develop, there is interesting what, we had COVID, so you still remember. And Trump actually did something very interesting. He told Pfizer, we need that vaccine quickly. And it was very, very interesting what he did, and we got the vaccine very quickly. Here they also used the Pfizer vaccine, or they had their own vaccines? Pfizer vaccine. So now, what was the major thing that Trump had to promise Pfizer to get Pfizer to work full steam ahead? He had to say, hey, listen, if there are negative side effects, you will not be responsible. Okay, that was in the contract. You can imagine, because that is in pharmaceuticals, that is the major risk. So a pharmaceutical company, every pharmaceutical company, they come up with a new product. What is the risk? The risk is that, hey, listen, there are some side effects, and this is very interesting. The side effects, the immediate side effects, because you test the product, and by the way, with the COVID vaccines, we did not test the product. Usually when you have a new vaccine or you test it for 1 or 2 years, 3 years before it gets approved. With COVID, we didn't have the time. So it got approved very, very quickly. That's why Pfizer told Trump, hey, listen, we don't want to be liable for if anything happens. But you can imagine with any vaccine that it's being tested for 3 years. By the way, the testing of a vaccine is already very interesting because you have to find out what are the side effects. You know fairly sure that the bad effects of a vaccine are not short-term effects. But any vaccine today, any medicine you take, you don't know what the 20 or the 30-year risk things are, that it could damage you 20 or 30 years from now. Okay, that's a risk. And by the way, whenever you take a medicine, you take the risk. Maybe the person who produced the medicine will be liable. But very often, if it's long enough, they will not be liable. Okay, so that is pharmaceuticals. So that's a product liability risk. Then you have regulatory risk. By the way, regulatory risk in the United States is fairly important because if we discover that a bank violates the regulations in the United States, that has happened a number of times, violates the regulations, the government can close the bank. And the government, you know how that goes. I don't know if that ever happened here in Korea. When the government decides to close the bank, basically what it means, another bank has to take it over. And the 3 top levels of management of this bank here that violated the regulation, all those people are fired. They lose their job. Okay, did that ever happen to Korea? That there were some regulatory violations and that the government so a regulatory risk is an issue in the United States. And there were some very interesting cases of regulatory risk. This was a big Japanese bank. It was called Daiwa Bank. It was one of the few Japanese banks operating in the United States. It had one guy doing funny things. And basically the US government came in and told Daiwa, sorry, you are not allowed to operate in the United States anymore. Just get out. By the way, that's a big deal. Huh? What effect does it have for Daiwa Bank? The reputation in Japan goes down the drain. So even though it's only in America they cannot operate, basically in Japan they cannot operate either. So they had to be taken over by another bank because they could not operate anywhere. Just basically because they could not operate in the United States. That happened maybe 7, 8 years ago. It was a very interesting case. It was really, you had to listen to all the legal things. That was a violation of regulatory risk. Well, you know sort of what cyber risk is. And you must have that here in Korea. Were there any interesting hacks here in Korea that a whole bunch of private data was stolen somewhere? I suppose. Usually in the United States that happens once a month. That some place lost 80 million people the data, etc., etc. It must happen here too. You know we always think, we are very prejudiced. We think it's always some Eastern European guy in Romania, Ukraine, or Russia, that they have a team. We are probably prejudiced that we always think it's an Eastern European. But up to now, the ones that we caught were all Eastern European. So somehow they get in, and somehow they can do a fair amount of damage. And if a company is hurt, by the way, not just it loses reputation, by the way, what is the loss of reputation? Because if that happens. So a company gets hacked. Now you have to look at the stock price of the company on the stock exchange before the hack and immediately after the hack had made public. Okay, and very often you see a 5% decline, which is money. Because if you have stock in money, there is stock in the company, you're losing some money. Okay, so that's loss of reputation. So loss of reputation means, and you can measure that, because the reputation risk loss is, hey, listen, some event happens, some message goes in the public, okay, this bank has been hacked, look at the stock price that day and see what the damage is. Okay, so you know what cyber risk is. You know what climate risk is. By the way, climate risk is actually very interesting. Because climate risk, there are lots of people that spending time worrying about climate risk. I try to think about it a little bit analytically whenever I talk with my colleagues in New York. For some reason, I'm not taken seriously. Because climate risk is it seems to be a very long-term risk. Very long-term, and by the way, it is a long-term risk. And maybe you have to think about what would happen and where do you want to live 20 years from now. In the United States, if you want to live, the climate may change. Climate may change. By how much it will change, we don't know. But there is also more short-term risk with climate. So the weather, hurricanes, etc., etc. So earthquakes are not part of that. Earthquakes are natural disasters, but have supposedly nothing to do with climate. But climate means tornadoes, typhoons, etc., etc. Now, it's not completely clear that if the weather people, they look at tornadoes and all that, and they tell all the people that say that climate risk is very, very dangerous, and we have it already right now, tell me that we nowadays have many more typhoons than we had years ago. Okay, and they come with data. In the United States, and also floods, in the United States, it's also that, first of all, we have a larger population. So there are more people subject to it. So more people, and not only that, the population buys houses very close to rivers and the sea in more vulnerable places. So that frequency, it's not really that easily that you can say, hey, listen, we have another typhoon. Because in the past, that typhoon was maybe somewhere and there were no people there and nobody was paying attention. So we don't know yet how to look at those statistics. So natural disaster risk, okay, we have a pandemic risk. That's actually very, very interesting to, with pandemic risk. What is the probability that we have another risk like COVID coming again? By the way, I usually have opinions that are different from all my colleagues in my department. And I'm one of the persons in my department. I'm the only person in my department that did not get COVID. Okay? So how many people here did not get COVID? There's only one.
Officially not.
Obviously not. What type of vitamins do you take?
Vitamin?
Yeah. No vitamins?
No vitamins.
Okay.
I have kimchi.
Okay. Well, I think that if you take vitamin, there was this French guy that was saying that you have to take zinc. You know, you have to take zinc. You took zinc? I took vitamin C and zinc. And I know 12 people that also didn't get COVID in the United States. All of them took very heavy dosages of vitamin C. Because there is a theory behind vitamin C. There is a reason. It strengthens the immune system. It strengthens the zinc does that too. And those people, of the 12 that I know, none of them got COVID. So I really was thinking, hey, listen, vitamin C, you know that it strengthens the immune system. How come that the government didn't tell the people, take vitamin C because it's very, very cheap. It has no side effects. It's very cheap. And if you you cannot take too much. If you take too much, you discharge it without any problems. So it's not really, but still, we had COVID and there was a lot of damage. I'm pretty sure that I wouldn't be surprised actually that in Korea, the damage, did they compare the damage from COVID here and in the United States? In the United States, it was worse, I'm pretty sure. How much worse?
I think our country is one of the best controlled.
Yeah, probably Korea and Taiwan probably also. Those were the two countries.
Follow the government's direction very well.
Yeah, you have discipline. Yeah, that's probably a factor. That's the people follow the government, and in the United States, the people are not that. But okay, you can imagine the pandemic risk. Pandemic risk is a very interesting risk. How are you going to deal with that? Now, think about geopolitical risk, because I got an email, geopolitical risk. No, nowadays it's a big thing. How are you, because you have to make investments, suppose you work for a bank, or maybe for your own personal investment, where are you going to put your money? There is a lot of geopolitical risk. There are a couple of wars going on. It's not clear how long the wars are going to last, and which companies are affected by which wars. Which currencies are going to be affected by which wars. You have to know that. Okay, so we talked already a little bit about reputation risk. By the way, there is reputation risk. Maybe you know British Petroleum. I don't think that reached here. British Petroleum had a drilling rig in the Gulf of Mexico. It was a big political thing in the United States. And there was a blowout. You know what a blowout is. And suddenly the oil comes and goes into the sea. And that was in the news every day for a couple of months. How can that happen and what is the damage? By the way, BP, immediately after that happened, the stock price of BP in comparison with other oil companies, they got a major hit. They got a major hit and BP actually is not really that well damaged. Okay, what are the types of risk interactions and propagation? When you analyze for your company the risk, you have to make sort of a diagram and you see here how the risks interact. First of all, you make strategic decisions, and that has strategic risk. Are you going to decide to do research to put a particular product on the market? That's strategic risk. There is a project risk, so you have to develop the project. You don't know how much time it is. By the way, even a software product, there is a project risk, product delivery delay, there is product liability. Those are all risks that are associated. So here's culture risk. Culture risk, very often you have in a bank or in a company, you have a certain type of culture. And the culture within a company are very often maintained by top management. They sort of, because of their behavior, they establish a certain culture. And with their culture, they have sort of the people behave in a certain way. By the way, people measure that. People measure how people behave. If they come on time, blah, 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 blah. That conduct risk can bring about operational risk, and operational risk can bring about reputation risk. So here you have all the types of risks can relate to each other. So a company in any type of business knows all those risks, how they impact one another. These risks here are risks that you make usually here. They are made in a very short-term time frame. That's based on decisions in a very short-term time frame. And these here, all those propagation effects have a long-term effect. So they can all have years of effect. Very often in the United States, if there are lawsuits, the lawsuits can go on for years. And there is an enormous amount of money that have to play. Okay, so we want to have for each company, we have to want the framework of the risks that each company is subject to. And then you know for each one the probabilities, the time frame, and so you can imagine that's not a simple exercise. Most companies, especially financial services, have a clear view of their risks. Nowadays, geopolitical risk is one that people are most worried about, and it's the hardest one to analyze and the hardest one to have prevention or mitigation actions. Okay, let's get the industries that have to deal with risk. The main industries, well, we talked about financial services and fintech. They are very subject to risks. Okay, so I told already, credit risk, market risk, operational risk. Oil and gas. Korea doesn't have an oil company. How big is it? Where does it drill for oil? It's just in distribution, or do they also drill?
They mainly do the distribution.
Only distribution, huh?
Yeah.
Yeah, in distribution there is not that much risk. The risk for an oil company is, suppose you have to go in the South China Sea and you have to start drilling holes in the sea. And you hope that the holes where you're going to drill holes that oil comes out. And very often you have a dry hole, okay? And every hole that you drill, and by the way, you employ geologists that are very expensive, and the geologists, they have a good salary. They tell you to start drilling here, and after 2 months, by the way, to bring in the equipment to drill there in the middle of the sea, costs money, and then no oil comes out. That's a certain, so what does an oil company, so that's where an oil company on that upstream, that's where the risk lies. Distribution, it's not, there's not that much risk in distribution. Maybe there is, but I don't think so. But you can imagine already what an oil company, what the risk is. How is an oil company going to prevent, how does it take insurance for that risk? Well, you know now, you know your history here, your geography. You know where Sakhalin Island is, huh? Sakhalin Island, it's fairly close by here. Sakhalin Island, it's part of Russia. It's Sakhalin Island, you know? How's my pronunciation? In the West, we say Sakhalin Island. Okay, it's part of Russia, you know that. Okay, so you know now that there are 2 big projects there, already for 20 years. Sakhalin 1 and Sakhalin 2. Sakhalin 1 is, I think, Royal Dutch Shell, Mitsubishi. You have to check ChatGPT. Okay, so it's Sakhalin 1 and Sakhalin 2. Those are, so you talk about a company like Royal Dutch Shell. It's a huge company. It's one of the biggest companies in the world. They cannot afford on their own to start drilling holes next to the Sakhalin Island. By the way, it's not true because you know it's cold up there. So you bring people up there to start drilling holes in the water. You have to pay them well. Otherwise, they don't. If they offer you a job to work on a drilling rig in Sakhalin Island, are you going to take it? Well, maybe they offer you so much money that you take it. So the people that work there get a good salary. But then you drill a hole there with all the equipment that you have to bring in there, and then the hole turns out to be a dry hole. Okay? So the Royal Dutch Shell, it's a company that makes profit. It makes more profit than Samsung. Huh? I think that the Dutch consider Samsung a small company in comparison with Royal Dutch Shell. Royal Dutch Shell, that's a large company. They make 20 billion a year. Okay? They cannot afford to start drilling holes in Sakhalin Island on their own. It's too risky. They cannot do that. So they really have to compute, hey, listen, we are going to drill holes there. We have to know what percentage of the project. Maybe we will be the leader of the project. That's all right. And maybe of the leader of the project, you get some extra money. But you have to insure yourself. So that means that you have to form an alliance. You have to form an alliance, and the oil companies know that. So in that type of, so oil companies in risk, that's actually very fascinating how they really have people computing probabilities, computing and say, and finance people say, how are we going to get in? Because the project already, because, well, check on ChatGPT, Sakhalin 1 and Sakhalin 2 are going on already for 20 years, I think. And it's, the amount of money involved, it's, you know, it's, a government cannot do that. That's why also the Russian government, they are a bunch of idiots, so they cannot do it. So they have to bring an outside company. But one outside company cannot do it. It has to be multiple outside companies. So there is a fair amount of alliances that have to be established just to minimize the risk. On top of that, they probably, after they make the alliance, they probably still buy insurance. So there are some insurance companies that are involved there also. So you have oil and gas, you have manufacturing companies, you have pharmaceutical, construction, healthcare. By the way, healthcare we have looked at, and I spoke about it yesterday a little bit about healthcare. In the United States, when you do a surgery, by the way, there is an interesting question that you can ask. How many of you went to a dentist and you had a tooth had to be pulled out? Well, at a certain age, once in a while, a tooth has to be pulled out. Okay, what is the probability that a dentist pulls the wrong tooth? You're laughing, because people are looking at that probability. So it's we call human error. So each tooth has a number, 1 to 32 or something. So he thinks about, he has seen the photos and he thinks that there is, this tooth has to be pulled out, okay? And it turns out after that, he finds out he made a mistake. Okay, by the way, that not often happens. It happens once in a while. Will he tell you that? Well, in the United States, we think that the dentist will not tell you that he pulled the wrong tooth, because he will say, you know, I see that the tooth next to it also has a problem. You think it's a joke, huh? This is something this is called human error and operational risk. Let me tell you another thing that is, that a couple of events happened that we could not understand this. Huh? And this was actually, you know, Yale University is supposedly a very, very good medical school. And Yale University, and they have a medical school, and they had an operation. There was actually a Korean lady involved there, that they had to take out a rib out of the chest, because the rib, there was some cancerous thing with the rib. So they go in, they take the rib out, and then they close again. Operation suddenly went perfect. The only thing they find out, they took the wrong rib. Okay? Listen, this is human error, and you would be surprised. And now there is something. If it would happen here in Korea, would it get known? Okay, so now, so they had to go back in because the other one had to be taken out. They tried to, and America is actually very, very funny. So the lady had to be operated upon again because the other rib had to be taken out. By the way, it's not a major thing because a person can, well, you want the chest, but still, okay, one rib is for sure all right. You can do with one rib less. 2 ribs, it becomes a little bit, okay? But now what happened, nothing was in the public. But then one nurse started talking. Okay, and now this is where the reputation loss comes in. Because the United States, the people are actually not that angry if you make an error. If you try to cover up the error, now you're in trouble. Now you're in trouble because now they get angry. You're allowed to make an error. Okay, well, no, it's quite sure if you're allowed to make an error. You're human, everybody is human, and humans make errors, but you're not allowed to cover up the error. Boy, Yale got a lot of flack because of that. A lot of flack because they tried to cover up. That happened maybe 5 years ago, and they lost a lot of reputation. People say, hey, listen, how can you do this? And then you try to cover up. There was another error at Duke Medical School, Duke University, also a very, very good school. They had a very, very long surgery. Okay, this is a heart-lung transplant. You know what a heart transplant is? There is something called a heart-lung transplant. That for one patient, they get both a new heart and a lung at the same time. So that's not a simple operation. Such an operation can last 15 hours. And if they are going to do such an operations, the doctors have timed that operation, and you know, it is a lot of project planning there. It's a project plan. We know exactly they have timed the operation. We are going to do this first, that first. They know, they have a Gantt chart of the operation because it goes for 15 hours. It was a Mexican girl. So they start the operation, and this happened maybe 10 years ago. And 6 hours into the operation, they noticed that the blood type of the donor did not match the blood type of the recipient, and nobody had checked. And now because can you imagine that happens? So you got the patient that passed away, because you're in operation, the operation is not going to go well, and you can close up, it's a heart lung, okay. So now, from an operational risk point of view, you think this is something that everybody should have checked beforehand, because that's the first thing you check. Hey, listen, we have a donor, we have a recipient. Okay, it would be nice if the donor's blood type matches the recipient's blood type. And why is it that nobody checked? Because it's such a basic thing that everybody thinks that somebody else already had checked it. Okay, and that could happen. And there was a big analysis done, because if such a mistake is made, you can imagine the investigation that goes into it. How come that can happen? And that happened. And then, so actually we learned there that if you have to check, even if you are 100% sure that many other people already have checked, you have to check again also. You have to check for the 100th time. There were some incredibly interesting mistakes in the medical world. And what we find, there is another one you want another statistic in the medical field. The medical field is, in the United States, 3 million babies get born a year, okay? Now, what do you think is the probability that when a baby gets born, it's dropped on the floor? What? How many? So of the 3 million, how many will be dropped on the floor?
About 1,000.
Yeah, it's around, the estimate is it's between 1,500 and 2,000. Okay, that's the estimate, because it's very hard to get reliable data, because people will cover up. People will not say. And there is one nice thing of babies, that babies are very resilient, that we don't actually very resilient, and so it's, babies can take more than we can take, okay? But still, you don't like to drop the baby on the floor, okay? And then, yeah, when you read all the things that can happen in the medical world, first of all, I think you get scared. When you read, we looked at things, when you read that, it's fascinating what can happen. And you really are afraid of going to the doctor. Well, they are human beings, they're gonna make mistakes. Another thing that you know what, you don't like airplanes to crash. Or airplanes to fly into each other. That's a problem, okay? Now, the FAA and the Koreans also, they have something called, you know what a near miss is? A near miss is, they are well defined. A near miss is that when two planes come within 200 yards of each other, and that the passengers in one plane wave to the passengers in one plane. Okay, that's a near miss. The FAA doesn't like that. They don't like near misses. There are actually two types of near misses. One that's at 200 yards and one that's at 500 yards. You can imagine 200 yards. Boy, you know the helicopter thing in Washington 2 months ago? Oh, that's a big investigation. What went on there? Unbelievable. So if you look at the statistics of near misses, okay, you don't step in a plane anymore because it's really scary how often there is a near miss. There is, and by the way, they do a lot of prevention. They like to prevent near misses. So you know already, when you, probably, I don't think that Incheon is a very busy airport. How is Incheon ranked as you have to go to ChatGPT here to what it's ranked worldwide. Now it depends on the number of runways it has, the amount of traffic, etc., etc. And now, very often, so when a plane takes off, first of all, the air traffic controller tells the guy, hey, listen, you can take off. Our
Engineering's
31?
third.
In the world?
Yes.
No.
It's one of busiest airports.
Is that so? How many runways does it have?
Roadways. Roadway, 6 active roadways. I know.
Oh, that's interesting. I didn't know that it's the third in the world. That's so, and how, well, you know what the reason is?
Passengers.
What?
In terms of the number of the passengers.
Yeah, but there may be a reason. You know what the reason is? How many airports does Seoul have? Seoul has 2 airports, but the other one is very small.
Yes,
One is for the domestic only.
they measure
Yeah.
the
Incheon is the
serve the
Yeah.
and
domestic.
has 2 terminals.
Yeah, it is because Incheon, there are only two airports in. Because think about New York. New York has 3 major airports. JFK, then they have a couple of other airports around it. You're talking about 6, 7 airports, all clustered. In Tokyo, I don't know what, they have 2, and Narita and Haneda. They have 2 major airports there. It depends also on the cluster of airports and what happens now. So if the air traffic controller tells the plane you can take off, not just the runway, you know, there is something called an exit point. Okay, so the pilot hears, okay, you can take off now. He knows which runway he is. And the guy tells him, you have to use this exit point. So the exit point is coordinates in the air. That he has to go maybe to the left, maybe to the right. It depends on the traffic. So the exit point has to be very well specified. And once in a while, they make mistakes in the exit points. And then then there is a chance that planes get too close to each other. If you look at air aviation, you get very interesting human errors and very interesting effects. Okay, so you can, by the way, there are sports, the sports game. What is the risk in sports? By the way, there are big risks. And I don't know how the teams here are. So you buy a player. If you buy a player for any type of sport, any team, there are millions of dollars involved. So of course you're going to take insurance. So there is special insurance, and the insurance companies have people that are really specialized in that, because if this guy is going to be hurt, then it's you lose a lot of money, because it's in the United States, it can be in the tens of millions of dollars. Okay, this is all the, okay, there is something that we have to know, that there are similarities and differences between the different industries, and the different industries can learn from each other. You know what, for example, the aviation industry practices are actually maybe the best with regard to risk prevention and risk mitigation. So how many minutes or hours do I have?
And you have train. Before that you have lunch.
Okay, so how many minutes we give you?
15.
50, okay. Let me tell you what industries can learn from each other. The aviation industry, for a very specific reason, has lots of prevention and mitigation, because with aviation, if something happens, there are 200 people dead. So if that can happen, you're going to do a lot to make sure it doesn't happen. If it's in the finance world, if some guy is doing something and the company loses 5 billion, it's just money. And then the company goes bankrupt, that's all right, that's not a big deal, okay? But if there are 200 people dead, that's a big deal. So the aviation industry, and actually it's the Americans were the most in operational control in the aviation, is they had the concept of a checklist already very, very early on. So you have a pilot and you have a co-pilot, and they have a list of things to check, and the pilot says, and one person has the sheet of paper, the other person does the checking, and they have to do it together. It cannot be one person doing it. It has two people have to do the checking. Two people have to do the checking, and so now what happened in the healthcare industry? In the healthcare industry, it often happens that you have a surgery, and you open up a person, and you use all kinds of equipment or utensils. You close the person and you leave those utensils inside. Okay, and that's a hassle, because then it means you have to open up the person again, just because. So what do they do before you close the person in a surgery? You check if you can know where all the utensils that you used during the surgery, where they are. And if everybody has checked on that, now you can close the person. That came from there. So you know what risk diversification, finance, oil and gas. By the way, semiconductor industry. Think about it, especially with, well, I think that at a certain moment, Samsung dominated the DRAM market. And they could develop the larger size DRAM on its own. Before that, there were still European players. And by the way, only to compete against Samsung, they had to join forces. So companies had to establish alliances in the semiconductor market, because to build a wafer fab, by the way, now I think that even if to build a wafer fab, for Samsung, a wafer fab is now what, 10 billion? How much does it cost to put a big wafer fab, to start a big wafer fab? It's 10 billion, well, Samsung still can do it. But there will be even a time that Samsung, at a certain moment, the items will become so complicated and the equipment becomes so expensive that in the semiconductor market, very often you have to make alliances. Well, here you can see a little bit. Dealing with human errors, that is actually a major issue in many industries. Okay, so what types of prevention, detection, mitigation procedures do we have in the various industries? So that's what you have to have: prevention, detection. By the way, why do I say detection? Suppose you have this trader in a foreign exchange desk that have made a mistake in a trade. Okay, now, so an error has been made and it's in the database, erroneous in the database. So there is something wrong in the database because the client thinks that the position is this and this and this, and in the database, it's somebody entered the wrong data. Okay, how long does it take you to detect that? So actually, when there is an error in the finance world, and we did tests at Goldman Sachs that were actually quite interesting. The test at Goldman Sachs, that first of all, an error is made. Very often you can find out later on the day it was made, that error was made. So human error was made on a particular day. Then it may have been detected on maybe 3 days later on a particular. By the way, in the database, you have to record all those different days. So it's detected on this day. It's done on this day. We think it's done on this day. It's detected on this day. Now we have to correct it. By the way, we may not be able to correct it even immediately after detection. So we have to, there is a correction process. So then we have to correct the error. So that means you have to do all kinds of trades. You have to do all kinds of trades to counter the error that you made before. So you do corrections. And after that, you have made losses or gains. You have to recognize the losses or gains on the books. So you have to compute what are the losses. So actually, in a trade, when you look at a database of trades, so imagine there are 50,000 trades a day, and each trade, how much information? Just to tell you, foreign exchange trade. What is a foreign exchange trade? It's a string of data. It's a string of data, and the smallest trade, the most common Mickey Mouse trade that's done electronically, that has maybe 8 pieces of data. It has a maturity date. It has the two currencies. It has the amount. Okay, we call that the notional. Okay, and then there may be eight parameters. You have complicated trades, that the string of data can be 100 parameters or 200 parameters. We have to, for example, specify that we, in this trade, which calendar are we going to use? Because the calendar, we can use the American calendar, or we can use the British calendar, and they have a free day when the king's birthday or something, and in America, or we can use any other. We have to. That's a parameter. So you can have 200 parameters in a trade. Complicated trades, very complicated. They cannot be done automatically. The complicated trade usually has to be done by a human. You cannot use ChatGPT or whatever. It can be complicated. So 200. Now, in any one of those parameters, there can be an error. Now, you can have major errors. By the way, the number of errors, so let me ask you then, 50,000 trades a day. So, and it would be interesting to find the numbers in the Korean situation. So a bank does 50,000 trades a day, and they go into the database. How many of them do you think have an error in them? What do you think? How many? 10? Between 1% and 2%. Okay? So you're talking about 500 to 1,000. Okay? That's I can tell you already, 500 and 1,000, and we compare that percentage, 1% and 2%, and we compared New York, all the same firm, New York, Goldman Sachs, London, and Tokyo. Which one was performing the best at the lowest error rate? Huh?
The one in Tokyo.
I first thought it should be Tokyo.
You should be.
It was the highest. So much for the Japanese. I thought it was New York was the lowest. I was very surprised. So we have to double check the data. I made an error. Something that cannot be New York the lowest. But it was New York was the lowest. It's interesting to find out. Now, there is still something else that you have. So we have 500 to 1,000 trades a day that have an error in them. Now there are major errors and minor errors. What's a minor error? For example, I told you which calendar we have to specify for the trade. We put in, instead of the American calendar, we put in the British calendar. It depends. Certain calendars have certain days off, and then payments are made on the day after or something like that. Okay. If you put in the wrong calendar, it's not a major mistake. It's a minor mistake. By the way, the wrong calendar still can induce a loss of $10,000, but $10,000 between you and me, the bank, the boss there at the bank, he does not pay attention to those $10,000 loss. Okay, that's a minor error. What's a major error? You put in the trade for Samsung, okay, that we are going to change dollars for one 6 months from now, and instead of 100 million that Samsung asked, you put in 1 billion. Okay, that is a difference. Okay, that is what we call a major error, because now you have to do a correction, and you can lose on that error easily $100,000. An error of that can cost $100,000. So now of the 1%, I'm not quite sure. I hope people are interested in this. Do you think they are interested in this? If you end up working for the finance world, what I tell you is actually useful. Believe it or not. But yeah, many of you. But by the way, Samsung, how many of the people that work for Samsung end up in the Samsung finance division? That they have to decide which trades to do. Because Samsung has a big finance. They have insurance, they have finance. So there are people that end up working for Samsung or Hyundai. They end up doing finance. I can guarantee you, if you know how to add and subtract, and you're going to work for Samsung or Hyundai, you may end up in the finance division because they have big finance divisions. I guarantee you. Okay. Okay, so now most of the errors are minor. Some of them are major. And if there are major error, then we have a history of, there is something called, if by chance you're interested in operational risk, I can guarantee you one thing. If you're interested in it, the probability you get a job upon graduation is 100%. That's really, there is no problem getting a job. Okay, so maybe you didn't know that this area existed, but it does exist and the banks know it exists. It is. So now, there is, the banks, you have to do a lot of statistics. Your knowledge of statistics has to be very, very good. And now people look at statistics. When a bank looks at what are all the errors the bank has, this bank, let's say the biggest bank in Korea, has made in the last 10 years. And they have the data. They look at the data, but the data from a statistical perspective, maybe they have 100 data points, 500 data points. From a statistical perspective, it's not enough data. So what did the 200 biggest banks in the world do? The 200 biggest banks in the world, now including even the Chinese banks, which were the last to join the club, they made a consortium. It's called the Operational Risk Exchange. And it was first in Switzerland, now it's in Britain. So all the banks give their data to this, and it is maybe 40 people, all of them statisticians, that put the data together and they analyze all the operational risk events that happened in the finance world. By the way, for insurance, they have a similar organization. They put it all together. Now, if you're a member, your bank is a member of this consortium, and you want to analyze your probabilities of the bank of making a particular mistake, you go to this consortium, and you're a member, and they give you the data of all 100 banks together for this particular mistake, for this particular. Now you can analyze the data. They don't tell you which bank had which mistake, so the data you get, they're somewhat anonymized. Because but usually all the big mistakes, everybody knows about it, because each bank actually keeps its own data set of what the other banks are doing. The ones that happen to appear in the newspaper, that the bank does. So the big banks here know all the major mistakes because they appear in the newspaper and they keep that data set. But you want also the minor mistakes, because the minor mistakes tell you a little bit. The probability of making minor mistakes tells you the probability of making major mistakes. And you need all the minor mistakes also. So you need all that data. So there is this organization that's called ORX. You can find it. They have a nice website, very nice website, Operational Risk Exchange. And there is a lot of data. Even as a non-member, you can get some data, because actually they want you to become a member. And you have to analyze now for the data that your particular bank can make this particular mistake and how much money are you going to lose. And then now you can decide what. Okay, this operational risk exchange is actually interesting to look at that website. And those people are not stupid. They are actually, all of them have PhDs. It doesn't say much, but they are educated. They know about statistics. Especially the type of statistics that you have to know for that. It's called extreme value theory. It's actually very interesting. They don't have a course here in extreme value theory, do they? You know, I have a big fight with our staff, and I was the head of the department that did statistics. In statistics, you have two limit theories. One you got in Euclid. It's called the central limit theory. Okay? That one you got. And you know what the central limit theory, there was a distribution involved there. That was the normal distribution. So you know the normal distribution by heart. Okay. That's one of the two theorems, but it's another important one. And the schools always do that one and not the other one. The other one is the extreme value theory. Okay. The extreme value, basically the central limit theorem tells you you have a whole bunch of random data. And what is the distribution of the average of those data? The sum of them divided by n, and what does it do in the limit? Okay, so you can imagine that. And then you get the normal distribution. The extreme value theorem, you have again a whole bunch of data, just like the central limit theorem, but now you're interested in the distribution of the max of them. So for a company, that's very important because the max tells you that one event that is the damage, that event is going to knock out the company. Okay, so you're interested in the distribution of the max. Okay, now what is the extreme value theorem? So this is a big fight. Actually, at Columbia, they followed my advice. So there is an extreme value theorem that tells you that if that number of, any one of you have heard of the extreme value theorem? Oh, you did. You had it in class.
No, I studied about the insurance and risk management, so I
Oh,
heard
okay.
about it.
Oh, in insurance, yeah. If you study insurance, you have to. So there is interesting distributions that come. So there is something called the Pareto distribution, not the normal. Normal distribution is it's for my granddaughters that are 8 years old. It's not for serious people. Okay? So the extreme value distribution, so the normal distribution has two parameters, the mu and the sigma. And all our students think that all distributions have two parameters, mu and sigma, mean and the variance. The extreme value distributions have three parameters. And now that's the important one. You have the mu again, the mean, the sigma of the variance, and then you have the xi. How did you call that? Xi. You know what a xi is of the extreme? It's the thickness of the tail of that distribution. And that's what you're interested in. In finance and in insurance, you're interested in the tail of that distribution because that tells you a little bit about the probability that you are going to be hit by a disastrous event. That tail of the distribution. And that Pareto distribution, or also there are several distributions, that tells you a little bit. So that actually, in our courses, we don't teach them that enough. I want to teach them. Okay, let's evaluation, prevention, and mitigation methods. If you want, you can get the slides and you look at the slides if you're interested. I hope that you're somewhat interested. That's not a complete waste of your time. But so how many minutes do I have?
It has already.
Okay, you can get the slides and you can look at it on your own and don't underestimate this field because you can get jobs not just at the banks and the insurance companies. You can get jobs at Samsung and Hyundai also and POSTECH because they also want to know probabilities and you have to be very good at statistics. Okay, let me, you have any questions or whatever, and you can look at the slides and see what you're.
So if you have any questions,
Yeah.
Thank you for the good seminar for us. Thank you for the good seminar for us.
Yeah.
So yeah, as I said, I studied about the risk management, especially the part of cyber risk management.
Oh, that's
So
yeah.
now I research about how to effectively mitigate the cyber risk
Okay.
by the enterprise risk management or cyber risk management. So, but I always curious about how we can numerically measure the the effect of the cyber risk management or effect of the enterprise risk management. So for this research, I used only the accident data. It means that I used only the data after the accident.
Yeah.
So I want to know how we can measure the performance of the risk management before the accident.
Yeah, the probability that, there are some data sets of hacks, and the people that have the best data set, I found them in Germany, they keep track of it. And there are you can find some papers in Germany that track the number of hacks that appear and how much data was stolen. There are some people that have got some data about that. The prevention and mitigation, in the United States, there was one big prevention or mitigation, and they say, by the way, that happened at Equifax, that's a company in the United States, and at JP Morgan Chase, that a company is most vulnerable, that a hacker will not attack JP Morgan Chase directly. It tries to find who are the suppliers or who interacts with JP Morgan Chase and have some rights of getting into JP Morgan Chase, and they try to find through a supplier to get in. Equifax, it was clear what the supplier was. And Target had a very, very interesting example. You know Target, the Target case? That's interesting. That has been analyzed to that, how they got in, how they got all the data of all the clients of Target. They went in, the Target had the company that supplied the air conditioning in all the Target stores. That the company that did all the air conditioning in all the Target stores, they had the right to get into the Target systems. And so what do the hacker do? They go to that company, and through that way they get into Target. And so to the supplier. And that was a very interesting case. There are a couple of papers written on that. So the lesson of that case was, boy, you have to check all your suppliers. What are they doing and how are they protected themselves? So you have to check all your suppliers. Because there may be, you are as vulnerable as your most vulnerable supplier. Yeah, there is a fair amount of you can imagine. A lot of research has been done on that. You look at the number of papers, many papers. Okay, any other question?
Okay, thanks
Okay.
again, Professor
Okay.
Pinedo.